Most people believe they understand where their money goes. You earn it, you spend it, it disappears. Rent, food, transportation, bills. At the surface, the explanation feels simple. Money enters your life, and then it leaves through expenses. But inside an economic system, money rarely disappears. It moves. Every dollar that leaves your wallet continues traveling through the system. It becomes someone else's revenue, someone else's income, someone else's capital. Spending is not just consumption. It is the first step in a financial chain. Consider something ordinary, buying a meal at a restaurant. At the surface, the transaction seems straightforward. You exchange money for food. The money is gone. But inside the system, that money continues moving. Part of it becomes the restaurant's revenue. Part of it pays the staff. Part of it covers the cost of ingredients. Part of it goes to suppliers. Those suppliers then pay their workers. They purchase materials. They pay transportation companies. The same dollar begins circulating through multiple layers of the economy: businesses, workers, producers, distributors. Every transaction pushes money deeper into the system. The process continues far beyond the original purchase. Companies reinvest profits. They expand operations. They borrow capital to grow. Investors fund those expansions. Banks finance those loans. Financial institutions manage the flow of capital. What began as a simple purchase becomes a chain reaction inside the economic structure. This is the first thing most people never see. Spending is not an ending. It is a redirection. Money moves from individuals into businesses, from businesses into wages, from wages into new spending. The system depends on this circulation. If money stopped moving, economic activity would slow immediately. This is why economies are often described as systems of flow. Money travels constantly between households, businesses, and financial institutions. But individuals usually only see their part of the movement. Income arrives, expenses remove it. What remains invisible is the path money takes afterward. Once it enters the system, it begins moving through structures designed to keep capital circulating. Businesses reinvest. Banks lend. Markets expand. And every one of those structures quietly channels money toward new destinations. Understanding this movement changes how spending is interpreted, because money rarely disappears. It simply continues traveling through a system far larger than the moment where it left your hands. After money moves through path, debt. Most people think of debt as something personal: a credit card balance, a car loan, a mortgage, something owed, something that must eventually be paid back. But inside the financial system, debt plays a much larger role. It moves money forward in time. When a bank issues a loan, the money being used often did not previously exist in that exact form. Credit expands the supply of money circulating through the system. That credit allows individuals and businesses to spend today using future income. Homes are purchased, businesses expand, infrastructure is built. Debt accelerates economic movement. It increases the speed at which money flows. A mortgage does not simply transfer money from a borrower to a seller. It activates an entire financial chain. The bank issues the loan. The borrower purchases the property. The seller receives the funds. Construction companies build new housing. Suppliers provide materials. Each stage redirects capital through additional layers of the economy. But debt introduces another mechanism as well: interest. Interest is the price paid for using money over time. Borrowers receive capital immediately. Lenders receive a return as the debt is repaid. Over years, this interest becomes a steady financial current flowing back toward lenders and institutions. Mortgage payments move toward banks. Credit card interest moves toward financial companies. Corporate debt payments move toward bondholders and investors. This creates a long-term redistribution of money. Small monthly payments accumulate into large streams of capital moving through the financial system. And because debt exists everywhere in modern economies, homes, cars, education, business expansion, government financing, the flow of interest becomes one of the largest financial movements inside the system. Every payment made on a loan quietly redirects money through institutional structures, banks, bond markets, investment funds. These institutions collect and recycle that capital. They lend again. They invest again. They expand credit again. The system grows through this cycle. Borrow, spend, repay, borrow again. Debt does not simply fund purchases. It multiplies financial activity. But it also channels a continuous stream of payments toward the institutions providing capital. Over time, this creates one of the most powerful financial flows in the economy. Interest moving steadily through the system, which means that every loan is not just a transaction, it is a long-term financial pathway. Money moves forward when the loan is issued, and then gradually moves back through the system as the debt is repaid. Pause for a second. If you're still listening, it's probably because this didn't feel exaggerated. That's intentional. If this way of thinking matters to you, like the video, subscribe. We'll keep going deeper. Spending moves money. Debt accelerates its movement. But there is another force quietly reshaping where money ends up. Inflation. Most people think of inflation as rising prices. Groceries become more expensive, rent increases, everyday expenses slowly climb higher. But inflation is not only about prices, it is about purchasing power. When the supply of money expands faster than the supply of goods and services, the value of each individual unit of money begins to decline. The same dollar buys slightly less than it did before. The change is gradual, often barely noticeable in the short term, but over long periods of time, the effect becomes significant. This is where the system quietly redistributes financial value. Because inflation does not affect every part of the economy equally. Some prices rise quickly, others rise slowly. Some assets increase dramatically, while wages often adjust much more gradually. This uneven movement creates a structural shift. Those connected to appreciating assets often see their capital rise alongside inflation. Real estate values increase, equity markets expand. Physical assets gain nominal value as prices adjust. Meanwhile, money sitting still does not participate in that expansion. Cash savings maintain their numerical value, but their purchasing power slowly declines. This is why inflation behaves like a silent current inside the financial system. It constantly reshapes the real value of money. Over time, the difference becomes visible. Assets rise, prices rise, costs rise. But money that remains static gradually buys less. Inflation also interacts with debt in an interesting way. When prices and wages rise over time, fixed debt obligations become easier to repay in real terms. A mortgage issued decades earlier remains fixed in nominal dollars, but the purchasing power of those dollars declines, which means inflation can quietly reduce the real burden of long-term debt. This dynamic benefits borrowers holding appreciating assets, while lenders rely on interest to compensate for the changing value of money. These movements occur constantly within modern economies. Money expands, prices adjust, assets reprice. But individuals rarely see this full process. What they experience instead are symptoms: higher prices, rising costs, a sense that money does not stretch as far as it once did. Inflation quietly reshapes the destination of money over time, not by removing it from the system, but by gradually altering what each dollar can actually command. Once spending, debt, and inflation are seen together, a clearer picture begins to appear. Money is never static inside the system. It is always moving. Spending pushes it into businesses. Debt accelerates its movement through credit. Inflation reshapes its value over time. These three forces operate continuously. Most people only see small fragments of the process. A paycheck arrives, expenses remove it. Prices rise. Debt payments leave the account every month. From the personal perspective, money seems to appear and then disappear. But inside the system, it rarely disappears at all. It simply changes direction. When you spend money, it becomes revenue for a business. That business pays wages. Those wages circulate through new spending. When debt is issued, credit expands the flow of money forward in time. Borrowers spend. Lenders collect interest. Capital moves through financial institutions. And as inflation slowly reshapes purchasing power, the real value of money shifts across the entire system. Assets reprice. Costs increase. Savings lose a portion of their purchasing power. All of these movements occur simultaneously, quietly, continuously. The result is a financial environment where money is constantly redistributing itself through different channels. Some channels move quickly, others move slowly, but none of them remain still. Understanding this changes how money itself is perceived. Because money is not just a personal tool, it is part of a larger economic circulation. Every dollar interacts with institutions, businesses, banks, markets, and each of those structures redirects the flow in new directions. This is why the question of where money goes is rarely simple. It does not travel in a straight line. It moves through systems designed to keep capital circulating. Spending, credit, investment. The system continuously absorbs money and then redistributes it through new paths. Once that movement becomes visible, financial behavior begins to make more sense. Spending reveals where capital enters the system. Debt reveals how the system accelerates growth. Inflation reveals how purchasing power shifts over time. Together, they form the currents shaping where money ultimately ends up. If this clarified how the system moves money, subscribe. Like this if it shifted your perspective.